Hello, this is Mr. Smith, and this is the daily participation. You can click on resubmit, and a text box will open up, and you can type three significant items from today's lesson. So today we'll talk about central banking. And a central bank is a national bank that provides financial and banking services for the country's government and the commercial banking system, some supervision, some loaning abilities, and influence over the money supply. In the United States, our central bank is the Federal Reserve. We'll talk more about that tomorrow, but today we'll talk about how the central banking system has developed over time. Looking at this timeline here, you can see 1690 to 1776, money and banking in colonial America obviously involved a lot of the British rule. American colonists were limited to using European coins, commodity money, which is currency that also has value as itself as objects, like using pieces of gold, for instance, and bartering. And all those were used as the primary means of exchange. There were shortages in foreign coins and inefficiencies in the bartering system and commodity money. So many colonies decided to make their own coins or issue paper currency for transactions. But that just means you had a system with many variables that often was confusing or inefficient. Unlike the banking system today, banks in the colonies did not take deposits or make loans. Instead, they issued paper currency backed by land or precious metals such as gold. So if they had banknotes or paper bills they issued, they had to be backed by one of those things, precious metals or land. The primary sources of loans basically came through wealthy merchants and other individuals. This was, of course, incredibly ineffective because people lacked faith in the colonial currency. And the right of a colony to issue money was often challenged by British rulers because they said, what right do you have to do this? We have our own currency system. And the system of using individuals to loan obviously was complex and left people at the behest of these elite individuals. So eventually there would be some experimentation after the Declaration of Independence. We obviously had a weak government under the Articles of Confederation, but the new government under the Constitution would experiment with our first attempts at centralized banking. And that would take a little while because remember the actual Constitution wasn't ratified until 1789, and the election had to happen, and then the President of the United States, George Washington, appointed the first Secretary of the Treasury, Alexander Hamilton. So Hamilton proposed, especially since there was a large amount of debt held by the states and also by the Continental Congress, which had been inherited by the new American Congress, he decided to propose the first central bank that would exist in the U.S. He believed that this new central bank would establish a national currency, replacing the notes that were issued by the colonies, which were now states. The federal bank would also carry out all financial matters for the United States government and provide a safe place to store government funds. But not everyone thought that was a good idea. Thomas Jefferson pointed out that there was no bank listed in the Constitution, and being a strict constructionist, he believed the Constitution should be followed literally. And he also was suspicious of banks because he believed that the nation was better off if it just stuck with agriculture and was only made up of farmers. And then all of the value, the source of their wealth would be the land itself. Storing up large amounts of money and other types of means he didn't think was a very good idea. He and people in the agriculture sector, which made up the majority of the economy, were suspicious of banks. And so they didn't like the idea of having this larger, more powerful bank in turn. Hamilton, though, was supported by the Federalist Party and won the debate and convinced George Washington of its merit. And so the first Bank of the United States was chartered in 1791. To reassure the people, only a 20-year charter was given. So that way, if it was too powerful, it would just simply expire after that time. And it was a great success and helped stabilize the country's economy and helped reassure creditors, those who had loaned us money during the War for Independence, that we were trustworthy. So at the end of the 20-year charter, so it started in 1791, at the end of that 20 years, it was decided it wasn't really necessary to have it anymore. But of course, then we had the War of 1812. And after a war like that, we often have economic instability and large amounts of debt. And so in 1816, it was decided to start the central bank again, except this time it would be called the Second Bank of the United States. And it would also be issued with a 20-year charter. And this time as well, it managed to help stabilize the country's economy again. However, there were still some that doubted its legality. In 1819, for instance, the state of Maryland decided to tax the local branch of the Second Bank of the United States. And so the cashier sued the state of Maryland over that, McCulloch, and then eventually went to the Supreme Court, and the Supreme Court decided that the state did not have power, including taxing power, over a federal entity, and they also declared that the bank was in fact constitutional, since Congress had the right to protect the economy and commerce. So, at the end of the 20-year charter, though, because the economy had stabilized, even though the Supreme Court had verified that it was okay for this bank to exist and that it was within federal power, which was superior to the states, there are still many suspicious of it, including Andrew Jackson. Like Thomas Jefferson, Andrew Jackson did not necessarily understand finances or money, and so he believed that this Second Bank of the United States favored the rich and foreigners. And there was some truth in that, because foreigners obviously had a lot to benefit from having a central bank. And then, of course, foreign countries had loaned the United States money. And the rich obviously benefit from banks more than those that don't have money, because that's what banks do. They take money, they invest it, and they make more money on top of that. So the more money you have, the more you benefit from the bank. But because of his suspicions, Andrew Jackson, who at this point had vetoed more legislation than the previous presidents combined, decided to also veto the rechartering of the Second Bank of the United States. So we entered the free banking era, which existed from 1837 to 1863. And there were a lot of problems that occurred during this period of time. Banks on the frontier couldn't be trusted or stable. They were known as wildcat banks. Large amounts of fraud occurred. Bank employees, false banks started up to take people's money. There were also a lot of panics that happened. A rumor would spread around the bank was closing, so people would rush to the bank, pull out all their money, and of course they didn't have enough cash on hand to cover everyone, and so they eventually did have to close, so it became a self-fulfilling prophecy. And then, of course, the states went back to printing their own currencies, which became a problem because other institutions, other organizations were also printing their own currency as well, so it became this very chaotic system. And so this was known as the free banking era. And so for a 25-year period, the U.S. banking system was a collection of state charter banks and commercial banks operating without any federal regulation. And so by 1860, there were nearly 8,000 state banks, each issuing its own paper notes or bills. And so this created an incredibly unstable, unreliable system. And starting with the Civil War in 1863, especially with the more conservative people at this time, be the Democratic Party in the South, withdrawing from the country illegally, the Republicans, who favored a more liberal government intervention, started to pass legislation to centralize the system, but they would not officially start a central bank. The need for reliable financing during the Civil War prompted them to pass the National Banking Act in 1863. This legislation created a uniform national currency and permitted only nationally chartered banks to issue bank notes. So this legislation cleared up the problem of having thousands of different banknotes in circulation, but it didn't create a strong centralized banking structure. And so the country continued to industrialize, and it had these incredible expansions in the economy and then sharp contractions to correct for overinvestment and overlending. And with all of these rises and falls like a roller coaster, there were still lots of bank panics or runs on the bank to pull out their money. And so banks weren't keeping enough cash on hand to meet customer need during these times. And news of one bank running out of cash would often cause panic in other banks, and so it would create waves of worry. And if a large number of banks were unable to meet the sudden demand for cash, it would sometimes trigger a massive series of bank failures. And at this time, they weren't insured. And so in 1907, a particularly severe panic occurred, and ended only when one person, J.P. Morgan, used his personal wealth to arrange for emergency loans for bank. Now, of course, that was nice of him, but obviously it also concerned people. If you remember, often these individuals were either called captains of industry or robber barons. So there's a considerable amount of the population didn't trust handing this much power to one person, even if it was in the best interest of the country to save the economy. And so many Americans had become convinced the nation needed a centralized bank, to supervise the monetary system. And so that is when the Federal Reserve would be created, and that is the system that we have today. And there are a lot of concerns, should it be government controlled, should it be private controlled? So it's kind of a hybrid system. And it would not necessarily follow the best practices because they just didn't know any better. Remember, before the Great Depression, the best economic activity for any type of entity was basically to stay out of the business, have a laissez-faire type of outlook. But of course, that would be bad during the Great Depression and would cause even more problems. And so the Federal Reserve System would constantly evolve to meet these new conditions. And after the Great Depression had started, the Federal Reserve started to take its powers more seriously and would become more of a nurturer and nanny for the overall economy to make sure that these contractions, when they did happen, were hopefully short-lived, using various methods in order to do that, which we'll talk more about later. So you can see it has there 1913 to 2010. There would be an evolution of the Federal Reserve System that would occur.